Hello everyone, I am Dr. Swati Gupta and today I am going to explain current ratio. The current ratio is a financial measure that tells us whether a company can pay its short-term debts using its short-term assets. It shows if a company has enough resources to handle its immediate financial obligations. Formula for current ratio is equal to current assets divided by current liabilities. What is current assets? It is the assets the company owns that can be turned into cash within 1 year. It includes cash, inventory. In inventory, that products come, which company plans to sell, marketable securities, that investment that can be sold quickly, and prepaid expenses, payments made in advance like rent or insurance. Current liabilities, debts and obligations the company must pay within a year. It includes accounts payable, short-term loans, taxes payable, wages and interest. The current ratio tells us how well a company can handle its short-term financial responsibilities. If current ratio is more than 1, it means the company has more assets than liabilities and company can comfortably pay off its short-term debts and it is a good sign for a company. If current ratio is less than 1, it means the company might struggle to pay its short-term debts. This could indicate financial trouble in the company. If current ratio is equal to 1, it means the company has just enough assets to cover its liabilities, but there is no extra cushion for unexpected expenses. We can understand it with an example. Suppose a company has a current assets of 5 lakh rupee and current liabilities of 2 lakh 50,000 rupee. So current ratio is equal to current assets divided by current liabilities, 5 lakh divided by 2 lakh 50,000. Current ratio is equal to 2. It means the company has twice the amount of assets needed to cover its short-term debts. A healthy current ratio is typically between 1.5 and 2. It means the company has 1.5 to 2 times more assets than liabilities. However, the ideal ratio depends on the industry also. Retail and manufacturing companies which keep large amount of inventory usually have higher current ratio while technology and service companies may have lower current ratios and still be financially healthy. Now, advantages of the current ratio. First, simple and easy to calculate. It uses simple data from a company's financial statement. That's why it is easy to calculate. Second, provides a quick snapshot of liquidity. It helps to access how well a company can handle short-term financial needs. Thus, the current ratio provides an instant snapshot of a company's liquidity and making it useful for quick decision making. Third, useful for short-term financial planning. Businesses need to plan their cash flow, debt repayment, and operational expenses. The current ratio helps in this planning by showing whether a company has sufficient liquidity to cover its upcoming payments. Fourth, helps in credit worthiness assessment. Lenders and investors analyze a company's financial health before providing loans or making investment. And they check the current ratio before lending money or investing because they prefer to lend money to those companies or they prefer to invest in those companies which have strong liquidity. Fifth, allows industry and competitor comparison. Companies often compare their current ratio with industry average or competitors to evaluate their financial health. It helps them to see where they stand in the market and identify areas for improvement. Sixth, assist in risk management. Monitoring the current ratio over time helps company to identify financial risk early. If the ratio is declining, the company can take corrective actions and it helps to avoid liquidity crisis. Seventh, can be used in trend analysis. Watching the current ratio over time helps in identifying financial strength or weakness of the company. An increasing trend shows the company's strength with its liquidity position, and a declining trend may indicate rising financial risk. It helps business make strategic decisions about growth, expansion and investment. Now, limitations of the current ratio. First, ignores the quality of current assets. The current ratio only considers the total value of current assets but does not assess their liquidity or quality. Some current assets, like inventory, may not be easily converted into cash in the short term. A company may have a high current ratio due to large inventory, but if the inventory is slow moving, it may not help in meeting short term obligations. Second, does not consider cash flow. A company may have a good current ratio but still face cash shortage due to delayed customer payments. It also does not show whether a company is generating enough cash to meet its liabilities. Third, industry differences make comparison tricky. Different industries have different working capital requirements, and it makes it difficult to compare companies across sectors. Manufacturing and retail companies often have high inventory level and naturally higher current ratio, but technology and service companies typically have fewer current assets and lower ratio. Comparing the current ratio of a software company to a retail company may be misleading as their business models are completely different. Fourth, can be manipulated. Companies can artificially inflate their current ratio by adjusting financial statement before reporting periods. For example, a company may delay paying suppliers for 1 month, which temporarily increases cash and pushes the current ratio high. This manipulation makes the company appear more liquid than it actually is. Fifth, does not consider short term debt structure. The current ratio does not show when short term liabilities are due, whether they need to be paid immediately or can be spread over time. Concluding it, we can say the current ratio is a useful financial tool that helps to access a company's short term financial health. However, it should always be used with other financial metrics such as the quick ratio and cash flow to get a complete picture of a company's financial strength. Thank you.